All right. Hello. Good morning. Good afternoon. Good evening. Thank you for joining us for yet another Solace Office Hours. My name is Aaron from Solace, and today we're going to be talking about Solace in all sorts of financial services use cases. And to help me with that, I'm going to bring on my two very dear colleagues, Himanshu and TK. Good morning. Hello.
Hey, Aaron, how's it going?
Hey. Hello, Aaron. Hello, audience.
Hello, gentlemen. Hey, do you want to introduce yourselves?
Sure. My name is Himanshu. I've been at Solace for about more than 6 years now. So I'm a senior solutions engineer at Solace, based out of New York, New Jersey area. And before that, I was working at a hedge fund and an investment bank. So currently, I work with our capital markets customers in helping them architect their solutions with Solace.
Yep. And my name is Kunnumpurath, also known as TK for short. I run the pre-sales engineering team for Solace for the Americas. So we have a team of solutions engineers across Canada, United States, and Latin America. And as like Himanshu said, we help solutions Solace, the platform, into customer use cases across many different industry verticals, including capital markets.
Awesome. Thanks, gents. I've been at Solace almost 15 years now, and during that time, I mean, obviously, I was a developer advocate for many years when I was based in Singapore. But I have also worked with quite a few financial services customers, as Solace was pretty much primarily only selling to those early days. And now that I'm back to being a solutions engineer, Himanshu and I are on the same team. I'm back to working with some of our big financial services customers. So. Now you're both coming. Where are you guys joining us from, by the way? I always kind of throw this out there when we start one of these office hours. Say hello. If you're out there listening, put it in the chat. Where are you guys joining us from?
So I'm based out of the New York office, but I primarily work from home in Jersey City. So in 15 minutes away from our office in Manhattan, Midtown. But
take the path train across there.
I take the bus, but yeah, path is another way to get into the city. Yeah, I take the bus into Port Authority, but right now I'm working from Jersey City.
All right.
Yeah, and I'm based out of Columbus, Ohio, but I'm somewhere in the country almost every week, visiting customers and visiting my team as well.
How's the airport there? Is it nice?
Yeah, it's nice. I could be at the airport like 15 minutes before boarding. I could still make it on time, which is lovely.
Excellent. Nice.
Yeah.
You've read Ready Player One, right? Because Columbus, Ohio features quite prominently in that book.
I've seen the movie. I haven't read the book.
Better. The book's better, in my opinion. Yeah, that's right.
Okay.
That's right. Anyway, we are live on LinkedIn, YouTube, and on the Solace community. It is October 28th, 2025. Happy Halloween for those who still like to do that kind of stuff. Say hello. Put it in the chat. Hey, we got one comment. Sean, hello. Thank you for checking us out. All right, so gents, we are here to talk about. Let me just move that. There we go. So we're here to talk about Solace and finance, right? Solace, for the longest time in the company's history, pretty much only primarily sold to financial services companies. We had our hardware form factor appliance, which everybody loved. It had really good performance, high throughput, low latency, just rack and run. As we've moved to, kind of supporting software in the cloud, we've diversified our client base significantly, but financial services is still a really big part of that, right? So we're going to talk about some of the features that Solace has that that are in demand from our customers in that regard. But to kind of talk a little bit level set around financial services in general, just to get an overview. TK, I think you got some slides to show off.
Yeah,
and we can kind of walk through those, and then we can kind of considering how these companies make their money and do their business, and then we can talk about how Solace fits into that. So let's go ahead and add your screen. There we go.
Yep. All right. Cool.
Over to you, TK.
All right. Thanks a lot. So in my past life, I was a customer of Solace at an investment bank, and just a bit about my career history. So my first job was actually when I was in college. I worked for a company called JVC. For those of us old enough to remember VHS cassette tapes, the claim to fame of that company is they created that format And then my first job after college was at Deutsche Bank, where I was working on the fixed income trading technology team. And that's where I deployed Solace. Then from there, I went to Capital One, did building out credit card payment systems. And then I joined Solace, where I am to this day. So a little bit about capital markets. And financial services consists of a variety of things, right? It includes like retail banking, consumer banking. It also consists of capital markets. And that's really where Solace made a name for ourselves. And capital markets roughly broken down into these three business lines. You have foreign exchange, you have fixed income, and you have equities. Now, as mentioned, I primarily came out of the fixed income sort of business line when I was at Deutsche Bank, and that's where I deployed Solace. But thought it'd be a good idea for those in the audience to get some background on fixed income and how that world works. So
before you jump in there, TK,
Sure.
I do have a question, and I do also want to throw up a few more shout outs to people. Kieran joining from Surrey in England. Good afternoon. Good to have you. Good to have you on there. Running Roach, Hong Kong. Good morning, good afternoon, good evening. How are you? Krishan, hello. And Prasant from Singapore. How's it going, man? Good to have you on. Thank you for joining. Thanks to everybody for saying hello. Fixed income, we're talking about bonds, we're talking about T-bills. Is that kind of all of those things fall under there? Okay, good.
Yep,
all right.
Absolutely.
Cool. All right, over back to you.
Okay, sounds good. So let's talk about how fixed income pricing works, right? So the U.S. government, they issue a bond, and the bond pays a certain amount of what is known as a coupon, which is the interest. And so in this case, you have a 1-year treasury bond, and you pay, just for the sake of this example, you pay $1,000 up front. Then every 6 months, you're going to receive that coupon. And then at the end of it, you'll get your notional back, right? So you'll get $1,050 at the end of it. If the treasury bond didn't fluctuate in price and you didn't trade it in between. And so there is an inverse relationship between the price you pay for a treasury bond and the yield or the return that you get, right? Sometimes these treasury bonds, depending on the market activity, could sell at a premium or discount, and we'll talk about why that would happen. So typically, when you do pay more for a treasury bond, say you paid $1,005 for the treasury bond up front to purchase it, your return is going to be less. So your yield is going to be less. And so there is an inverse relationship between price and yield. So the greater the price you pay for the treasury bond, the less return you're going to get. Okay. And so the treasury bonds come in a variety of maturities. They go all the way from 1 month to 30 years. And the shape of the returns that you get on the various instrument, it forms what is known as a yield curve. Now, historically, the yield curve, the shape of the yield curve would determine what state the economy is in, right? So this is a shorter term treasury bond on the left-hand side, and the right-hand side, you have the longer term. And then, so if your shorter term is giving less yield than your longer term, that means the economy is generally in a growth phase. And if the shorter term
projected to grow at least, right? So
yes, projected to grow.
Right.
Yeah. So if the shorter term is showing higher interest rates than the longer term, that means people are afraid of what's coming in the future. They want to invest in treasury bonds that will give guaranteed near-term returns. That would indicate a recession. And the middle is when you're in transition phase. However, if you have been paying attention to the headlines, the yield curve has actually looked like this for quite some time. So this sort of textbook definition of what a yield curve says of the economy, people will say it's no longer valid. In fact, part of this yield curve today is inverted. So this part, when it's inverted, that indicates recession, but it's been like that for years. So
interesting. So we're on the cusp of a recession for years and years, but
for years, yeah.
And
if you've been paying attention to the stock market, right, despite the negative headlines and the periodic dips, the stock market has been giving really good returns, right? So who knows what the future holds? But people have been putting less and less emphasis on the yield curve. You could see like headline news articles from CNBC, for example, that would say that it's no longer valid, right? But who knows? But this is essentially what you would learn, like if you're doing any sort of financial economics course. This is what the textbook would say.
Right.
Okay. Right. So why are treasuries really important? So it's a really important instrument for the entire world economy, to be honest, because for people in the United States and really across, like even in Canada would apply. Like it determines everything from your auto loan rates to your credit cards to your mortgage rates to the return you get in your savings account. It has an impact on your retirement accounts because some of your retirement will be invested or may be invested in treasury bonds. And still to this day, it's viewed as a risk-free asset. So governments around the world, banks around the world, they use treasury bonds. They invest a significant amount in treasury bonds. You could read a lot of headlines, perhaps that's changing, but to this day, I think that the standard risk-free asset is still the U.S. government treasury bond. Okay, right. So that's a bit it about 101. Aaron, Himanshu, any thoughts or questions on what I described?
Himanshu, I put you on mute, by the way. Oh, okay, yeah.
No, it's very fixed income heavy.
Yes.
But yeah, no, all good.
Okay. All right. So in my past life at Deutsche Bank, we built a next generation bond pricing engine that ultimately we moved over to Solace. So give a brief explanation of how bond pricing works. So as I mentioned, the government issues treasury bonds and they're called benchmarks. And the way you price a treasury bond is you get the feed from a variety of market data sources. And the architecture that you would typically use, you'd aggregate the feeds from these various market data sources, and then you'd provide the best broker picture or the best market data feed as the price level that you would internally price out to your clients. And so the aggregator's job is simply, as mentioned, to aggregate the various feeds and then give out the base price that our traders would use to price. So they'd add a spread on top of the price that they get from the aggregator, and it goes on for the variety of benchmarks. Okay, so this is how you would price the benchmarks. Now, there's also synthetic instruments that are used to traders use to trade as well. So the benchmark in this case is a 3-month and a 6-month. You could also come up with a synthetic instrument called the 4-month. And the way you would price a 4-month is, the aggregator would come in, we get data from its various sources. It would get the best picture for the 3-month and the 6-month, and then use interpolation to determine the price of the 4-month. Now, if you're paying attention to this animation, what happens at time t=1 is that the price for the 3-month and 6 months were passed on, and then the interpolator would calculate the price for the 4-month. And while that's happening, the price for the 6-month and 9-month is still being processed, and then the 7-month is perhaps based on a later price tick of the 6-month, right? So essentially, the prices for the 6-month are coming in at 2 different times because these are 2 independent processes. And so what that means is, and now as a trader, you are potentially pricing an inconsistent price based for the 4-month and the 7-month because they're based on an inconsistent price for the 6-month. Okay, so this led to inconsistencies, and that would cause a variety of issues. Like if you're a sophisticated trader who's trading with us at the time, you could potentially take advantage of like arbitrage opportunities and say that the 6 months is actually, or the 7-month is actually priced cheaper. I'm going to buy that and then sell it back to you. So you want, when you price out your instruments, you want to be as consistent as possible. So the instruments over here should be priced on the same exact broker picture or the market data at that point in time to give a consistent price for your entire yield curve.
Is this just a kind of synthetic demonstration here, or these synthetic instruments really do exist? And what?
Yeah, they do.
How many would there be? I mean, would you have one for every month for like up to 100 years, or like?
Yeah. So the benchmarks go all the way from like 30 days to 30 30 years, right? So
Right.
those are your benchmarks. You could have like as many, I don't know the exact number, but you could imagine like every single intermediate between that
Could have.
can be a candidate for a synthetic instrument.
Right. Okay. Interesting.
All right. And so the key thing is you want consistency when you price, right? So at every point when you push out a price, your yield curve should be based on the same exact price data points. And when our prior architecture had these as two independent processes, so it could open up to a race condition where you're pricing your yield curve based on different data points, which is not what you want to do. Okay.
Because you can go game the system there, maybe find that, yeah.
Yeah, exactly.
Yeah.
Right. And so now the other aspect of this, so that's sort of like how the pricing works. Now the technology that we used is a multicast technology, which at the time we used TIBCO Rendezvous for those familiar with that. And the way TIBCO and multicast, TIBCO is again multicast protocol. The way a multicast protocol works is essentially you have a publisher, you have a bunch of subscribers. These subscribers belong to a multicast group, which is essentially a network switch controlled grouping of subscribers. So the way it works is your publisher doesn't know anything about the subscribers, like the subscriber doesn't know anything about the publisher. The publisher would publish on the multicast group. Essentially, the switch architecture will determine who the subscribers are, and it would forward along the packet or the messages to the relevant subscribers. Now, it is a non-guaranteed protocol. Like essentially, multicast is like best effort messaging.
Fire and forget.
Yeah. Yep, fire and forget. That's right. And so what happens is that, say this subscriber had a brief network blip. It would come back online and realize, hey, I missed a packet from the publisher. And then what it would do is it would send a NAC directly back to that publisher. And then the publisher would respond and saying, hey, do I have this packet in my, or message in my cache? And then republish it. When it republishes it, since it doesn't know who the subscribers are, and it will the protocol made the assumption that, hey, if there's one subscriber that missed a packet, it's likely like a bunch of others did so as well. So to prevent that sort of NAC storm from happening, it would say, I'm going to republish this mismatch message to everybody. And the publisher, the subscribers that weren't interested in that message would simply say, I already received this message. I'm no longer interested in it, and I'll just discard it. And you can imagine a situation where this network link is flapping. You're going to get a bunch of NACs, and then you're going to get a bunch of messages being published. You're going to get a bunch of discards. And then soon enough, the messages that are being replayed or recovered are going to overwhelm these subscribers. They're also going to start sending a bunch of NACs. So this is what is known as a NAC storm. Now, the interesting thing about this is I was woken up, I remember, at Sunday at around 2 a.m. Or Monday at 2 a.m. when London was trading at the time. And they said, hey, our trading floor went offline. And so I was woken up, I was very, very groggy, and I decided to look into, what was causing this. And I had some tooling that I'd built out. And then I realized that there was a specific desktop that was causing this issue. So I told our IT operations folks, hey, go to this desktop and unplug it from the network.
Yeah.
As soon as we unplugged it, the trading floor resumed activity. And afterwards, the IT operations guy, I remember he sent me a picture of the network cable, and it ended up being like it was chewed out essentially. And at the time, it was in London, and it was based in the Canary Wharf district, the building, and they said that we have a rodent problem, and every so often we do have to replace network cables. So essentially, what happened is that a mouse chewed through the network cable, and that caused the trading desktop to flap with the switch. So it would go on and it would go off, it would go on and it would go off. That caused the multicast NAC storm to happen. Essentially, when it went off for a second, it would send a NAC back to the publisher, as I showed in this previous diagram, and then the publisher would republish a message, and then it may have missed it again because it went offline. Then it republished, so on and so forth. And so that was a funny anecdote because a mouse ended up causing like a very significant trading loss event to happen. It was in the many millions of dollars where the trading floor was taken out of the market.
So TK, would the knack happen every time the mouse would take a bite?
No. I think the cable was already bit, but it was in a bad state. So it would show as connected, and then it would disconnect because the signal was so weak, and so was the cable was in a very bad state. Right.
I remember something similar happened in the New York location where one of the data center had an issue because the mouse had damaged a cable. Must have been the pizza rat from New York.
I have a similar story, but it was a YouTube video. Some trader on the floor watched a YouTube video, caused their bandwidth to spike, and it caused the knacks to start happening. So I'm sure most of our customers out there who have dealt with RV probably have a story or two. Actually, just flip back one, TK.
Sure.
So in this case, like multicast as a kind of a UDP networking protocol, it becomes the publish subscribe bus, right? The network is the bus. You publish that multicast packet, but this whole kind of NAC and recovery mechanism, that's part of RV's protocol.
That is part of RV, right? Because by default, UDP multicast, as I said, is a fire and forget protocol. There's no recovery mechanism built in. So whatever API, whatever messaging that you're using has to build this recovery protocol on top of multicast.
I've heard that other multicast based kind of networking pub sub protocols tried to kind of avoid this by doing like a TCP or a unicast back to that subscriber who missed that one packet to try to isolate it unless it received more than 3 retransmit requests, and then it would publish it again as UDP. I've heard, there different customers try different things, or different products, but
there's a variety of evolutions of this recovery protocol. But I'd say is that based on personal experience as well, I've used Informatica Ultra Messaging in my past life, which offers multicast protocols as well. It doesn't work in practice. Like in theory, yes, you could try to eliminate NAC storms, but once you get into a uncontrollable situation, like a mouse biting through a network cable, you're going to end up in this similar sort of picture.
Sean's asking if PoE cables, I guess point of Ethernet. I don't know what PoE actually stands for, but would shock it. Yeah, maybe one big bite and it would.
But then the rat would die.
Yeah. Just to be clear, this was trading desktops, right? So this wasn't servers. So it was Ethernet cables that were plugged into the switch on the trading floor. I think in the server side, in the data center, you'd probably have a little bit more protections on different types of cables and more industrial strength cables and better controls of rodents as well. Because the trading floor shared the building, like you'd have a cafeteria, you'd have all this stuff and whatnot. So it was a little bit more difficult to control rodent infestations.
Power over Ethernet. Yeah, definitely. Okay, that would be shocking. All right, let's get that's enough UDP. Let's talk about how. There we go. Oh, okay.
Yeah. So this is just the outcomes of this is that traders were getting picked off. We had unhappy traders. We had unhappy customers who are trading with us as well because they sometimes wouldn't be given a fair price. And then we had these pesky NAC storms. So we decided to re-implement this entire architecture. Yep. Go ahead.
One more thing about that's interesting about the multicast way of communication is that it's drinking from the fire hose. So everyone subscribes to everything. There's no I want this versus you want that. Sorry.
Yes. Yeah, absolutely. So the multicast channel, your sort of level of filtering is essentially your multicast channel, which is a combination of multicast address as well as a UDP port. But that's partial filtering. Then you don't have things like we do in Solace where you could subscribe specifically on a topic, not have to worry about discarding everything else. So the way we architected on Solace, so we wanted a few things. We wanted to get away. Personally wanted to get away from waking up at 3 a.m. on a Monday morning to solve issues with trading floors on the other side of across the pond or other side of the world. Other thing we want to implement is more consistent pricing or consistent pricing. So every price that we pushed out was based on the same underlying set of market data. And so what we did essentially is we unified our architecture and pushed it over Solace. So we had a single aggregation layer that would take in the market data for the various instruments and then push out the market data as a single market data event. And then what we'd also do is we push that on a last value queue, because what happens is that when you push out this market data picture for all your instruments, there's a significant amount of activity that needs to happen to essentially calculate the yield curve. So you have to price your benchmarks, you have to price your non-benchmarks, then you push that out. So going through this directed acyclical graph does take an amount of time. Now it is measured in the microseconds, but given how fast the market may be moving, like perhaps the Fed raised or reduced their interest rate, it could be a significant amount of activity that's happening in the market. So essentially, we go through this direct acyclical graph, we would price out all these instruments, and then we push that out onto Solace, and then the traders would consume them from their trading desktops, as well as our pricing or matching engines would as well. So another problem that we had was that this was, when we implemented this, it was being pushed out extremely fast. If I recall correctly, we were at times pushing out like hundreds of prices a second, because Solace was very fast and our new architecture based on directed acyclical graph was very fast. Remember that these prices ultimately had to go to a trader desktop, and the most updates that a human eye could observe is, they say 3 times a second. So if you're pushing out 100 times prices a second on your trading blotter, it's going to be very difficult for a trader to understand what's going on. And so what we were able to do, take advantage of, well, we initially said, okay, we're going to develop a separate bond pricing engine for the trading desktop and a separate bond pricing engine for the server side. But Solace has this feature called alighting, which allows you to throttle events that are coming out from the event broker. So we essentially said, for these desktops, we're going to throttle these feeds for at most 3 updates a second, and then the desktop would get three updates a second. However, we had server-side processes that were subscribing, and some of them were used in algorithmic trading as well. They just subscribed normally without any alighting involved. They were getting the fast feed of 100 messages a second, because again, the human eye wasn't able to observe it, and they wanted to get the most recent price as quickly as possible, and process it, and then act on it, and perhaps do some algorithmic activity. So this was really, really valuable for us, because again, in previous architecture, it would mean 2 different pricing engines, one for the desktop, one for the algorithmic trading, and then you again run to potential inconsistencies between what the algorithmic trading engine is doing, whereas what our manual traders are doing, and it would be a very messy architecture. So yet another benefit of the Solace architecture: number 1, we got away from NAC storms. Number 2, we were able to unify the architecture for our server-side processes, such as algorithmic trading engines, as well as our trader desktops. And that just led us to have a global consistent price for the US dollar yield curve, which is extremely important. And it led to increased profitability. And at the time, we were rated number 1 in fixed income for a number of years after we rolled this architecture out.
We got a question there. So up at the top of your diagram, you had LVQ. Is that actually a last value queue, or are you talking about sell cash as a last value cash, or?
Yeah. So, sorry. Yeah, this should actually be a lost value cash, because at the end of the day, this is all direct messaging. So that's just for purpose, I guess, for simplicity understanding, this was mentioned as a last value queue, but it was a cache.
Because Solace does have a last value queue. So
yes.
Right. Yeah. For guaranteed messaging. So
yes.
Good question there, Running Roach. Thanks for that. So just to make sure that people alighting is a direct messaging feature that the Solace broker supports, hardware and software, where you can basically tune it for on a per topic basis, the broker will automatically drop or throttle messages on the same topic and only give you at a certain specified rate, like twice a second. You said 3 times a second there, TK. So yeah, you could. So even if you're getting updates at 100 times a second, it will throw away some for you. So like your screen's not flashing and going crazy with 100 updates a second. So that's awesome that was built in. That one feature just allowed you to kind of like harmonize your.
Yeah, exactly.
Okay.
Extremely valuable.
Cool.
Okay. And so the outcome of this, rate number 1 fixed income, improved stability, and customers or traders on the trading floor, as well as the customers who are purchasing and trading with Solace, also were way more happy with us. Okay. So that's really all I had to share.
Cool. Wow. Thanks for that. That's a nice overview. Himanshu, how's the construction noise going on in the background there? People are noticing it.
I'm hearing it from a different side now. It was happening on this side first. Now I'm hearing it from a different side.
It's perfect timing having the neighbors do.
I think both sides of neighbors decided to have construction on the same day.
That's awesome. Okay, so I mean, so the hardware appliance is probably one of our most well-known products. As we've had it since day one. The performance on it is quite amazing. And I have done office hours before. Our colleague Tom, based in the UK, did a bunch of latency testing, and we spent an entire hour talking about how to do latency testing in Solace. Some of the results we were getting, but the generally quoted benchmarks are around 20 microseconds of latency. And that's from publisher to subscriber, not just through the broker itself, right? So that's from publisher, send to the network, into the broker, out of the broker to the network, and to the receiving application is 20 microseconds. 18, 17 averages sometimes on some really high performance switches. But those are the kind of numbers that we're talking about here. So when TK is talking about some of these updates are coming in and how long it takes for these the budget of to kind of like do your pricing, having Solace be the smallest part of that, or at least not contribute to it too much is very important. And our software broker, when it came out several years ago, was certainly not tuned for latency. It was built primarily as a kind of for throughput. But we've been doing some work in the last little while. Solace has made some announcements, I think in 10.8, quite a few improvements. I know Sean did a product update not too long ago, talking about some of the improvements for guaranteed messaging specifically. I think sometimes like double or 3 times the performance, the throughput. But we have recently, Himanshu has recently done some testing with Oracle Cloud to test our software broker for latency use cases. So do you want to talk a little bit about that?
Yeah.
So before you do, let me pop up. We got a question here from Running Roach. For direct messaging, how did you handle slow updated data and network flap, thus missing the last message, which may be most critical?
Yeah, so that's a great question. So the key thing here is that prior to introducing Solace, right, we were based on multicast. Multicast, as we indicated, really has minimal filtering capabilities. And what we did, and we actually did this analysis and it really helped with the justification of deploying Solace globally, is that we showed with topic filtering, there were certain traders that saw, or certain trading desktops that saw up to a 90% reduction in traffic. So imagine, like, as a trader, you're only, the way the trading desk is set up is as a trader, you're only meant to trade on a specific end of the yield curve. So you have the short end traders, long end traders, you have the benchmark traders, so on and so forth. So you're only seeing a small subset of those instruments. And so that led to a significant reduction, and that gave more processing time, more network bandwidth to the trader. But on top of that, we also set up monitoring for discards as well. So if we saw increased discards, we could perhaps, a trader had YouTube and Bloomberg Terminal and a bunch of other things on his desktop, and we'd be able to quickly go over and say, cut it out, stop watching YouTube while you're trading, for example. And so that was another thing. And then, as you know, if we have a persistently slow consumer on Solace, we do identify him as slow, and then he gets kicked off the network before it starts impacting the appliance. So that's another benefit. We have proactive sort of capabilities to determine whether somebody's being slow and not have him affect the larger network. On the server side is a little bit more different because the server side was, our data centers, more bandwidth, and they were subscribing to the entire feed, like all the topics, and so we had increased monitoring those. We also had heartbeats between the pricing engine and the algorithmic trading, or all your subscribers, including the algorithmic trading engine. So if we saw missed heartbeats, we would know that there's potentially something wrong. We potentially take the algorithmic trading engine out of the market, so that will give us time to figure out what's going on before we start executing on stale trades and stale market data. So in a nutshell, yes, it is still a problem, but the key thing I'd like to emphasize, it could be a problem, I should say. Key thing I'd like to point out, as opposed to a multicast brokerless architecture, you do have an entity that you'd be able to monitor, specifically the Solace broker. That gives you visibility on how all the subscribers are performing, how many packets are discarded, whether they're being slow, and it will allow you to take proactive action quicker rather than having the mouse bite through your network cable and after the fact figure out that actually happened.
So I was gonna add a couple of things there. So yeah,
Sure.
you could tune your client profile buffers down a little bit smaller to make sure that you're not too far behind.
Yep.
The APIs, all of our APIs have the ability to detect whether a discard has occurred, like due to a buffer overrun,
Yes.
and therefore stop trading or go and resnap the cache to get to the most recent. Want to play devil's advocate though, TK. Could you not have just made more multicast groups? Could you not have made a group for each part of the yield curve, or what? Like,
there's a finite set of multicast groups that are available for you in the enterprise. I'm sure, like if the development team controlled the multicast network, perhaps we could do that. But there is, like, forget the exact count, but there are thousands of instruments, right? And then you're going to have to tie your application logic to map an instrument to a specific multicast group. So it becomes very, very difficult to do that if you are indeed going with the model of multicast group per instrument, which I think is infeasible because there's way too many instruments and a finite set of multicast groups.
And this is just fixed income, by the way. There are more asset classes that the bank is trading.
Use topics, everybody. Use Solace topics, smart
absolutely.
topics. One last comment from Running Roach here leads me to dream of an enlivening equivalent for guaranteed messaging to help throttle your guaranteed data. Enlightening is throwing away messages on purpose, though, and most people that are guaranteed want guaranteed. So you're throwing away things that were guaranteed.
Last value queue. Going back to my incorrect diagram, the last value queue does sort of do that. Like, it gives you the latest message, and that can be used as a recovery mechanism.
Just browse it every
with replay.
500 milliseconds, or something, and it'll go as the most recent. Yeah,
potentially. Yeah,
could do that. Himanshu, I was just about to talk. We're going to talk a little bit about software performance. Do you want to share your results and talk about that a bit?
Yeah, to just give some context. So, a lot of our customers in capital markets have been using these appliances for a long time for the right reason, and they still continue to use them for those specific use cases. But over time, maybe for the other use cases that don't require that kind of performance, they've also tagged along on this hardware, and now maybe those applications might want to move to the cloud, right? And they're more software friendly. They want everything infrastructure as code and all that stuff. So a lot of our customers have been asking, can I take some of my use cases that are running on these Solace appliances over the years and migrate them to the software broker, but get somewhat similar performance? I mean, they understand that they can't get exactly the same kind of performance that specific FPGA cards give you on a software broker running on containers on cloud infrastructure, right? So over the years, that gap has been getting narrower and narrower. And most recently, we did a bunch of different benchmark tests on different cloud providers. So I was specifically involved with the testing for OCI. Colleague of mine, Emerson, was involved with Azure, and another colleague is working on currently with AWS Outpost. So the numbers are similar. So I'll share them right now. We have.
Shout out to Emerson for all the help on Azure, because that was for actually one of my customers that I have taken over since I've moved back to Toronto. So, hey Emerson, if you're out there listening to this, thanks for doing all that. Look at all right, look at these numbers. This is in
Yes.
software in the
So,
cloud.
I do attend a lot of community events where everyone is still kind of saying, can I move my capital markets, financial services loads to the cloud? No, everyone has to be on-prem. And it's been going on for like a decade now. And, it was true in the beginning, but the kind of advancement that these cloud providers have made over the years, it's getting very close to what you have running on-prem right now, and maybe even better in some cases, right? So it's worth looking at what cutting-edge solutions they have now. There are new players like OCI in the game as well, what kind of offerings they have, what kind of egress costs that they can minimize or reduce completely. So it's worth reevaluating as long as it meets your requirements and what you're trying to achieve, right? So with OCI, we did a bunch of different tests, and this blog post is online, so you can take a look at all the details and different tests. But I'll just go over that. We tested both for throughput and latency. So a typical example would be that we deployed our software broker in an HA pair, which means that it's a triple nodes configuration where you have the primary broker, backup broker, and then lightweight monitoring node that's just kind of maintaining your quorum to avoid split brain scenarios. And this node is not really doing any messaging activity. It's only the primary broker and backup broker. These software brokers can be easily deployed using Docker, Podman, or can be deployed in Kubernetes as well. So pick your favorite flavor of Kubernetes, EKS, OpenShift, whatever, and you can easily deploy them. And Kubernetes does make things much easier, to manage in some respect. Whereas like if primary broker goes down, very easy failover to backup broker, and then the primary pod would come back up. All that sort of stuff that infrastructure as code and Kubernetes provide. Then what we did, we had a Kubernetes setup for spinning up a bunch of different publishers and subscriber processes as well, which were basically our SDK perf instances that's also available for our customers or anyone to download and publish data at different rates of different sizes and all that stuff. And then we had a separate host for doing latency testing as well, because we wanted to make sure we have the right host and it's as closely located to the primary broker, all that stuff.
So the reason for this particular setup, I mean, for those who don't do latency testing all the time on Solace and maybe didn't see our previous, you want to put load on the broker. So that's why Himanshu has this like big collection of publishers and subscribers. You're putting load on the broker, but the actual process that's doing the latency testing, you're measuring that from somewhere else, right? Like essentially we call it the latency probe or some other nomenclature like that. You don't try to measure latency while doing 400,000 messages a second from a single thread, right? Because you're not going to get very accurate results. It's not going to be indicative of what the broker is actually doing in terms of latency. You'll just be measuring the latency probably on your overstrung CPU process that's generating the load. So
correct. Right. Yeah. And this was used for the background load for latency testing, and then it was used as the major load for throughput testing as well. So we were trying to see how far can we push the broker, right? So we were trying to achieve a fan out of 5, so 40 times 5, 200. So for every one message we were publishing, we're trying to see that we can consume that message by 5 subscribers, and what kind of throughput can we achieve with that. So with OCI, we tried with the VMs and bare metal. So with VM, we had 16 Oracle CPUs, plenty of memory and plenty of network bandwidth. And you'll see we had network storage here with 100K IOPS and 1080 megs of bandwidth. And with the bare metals, it also had a lot of CPUs and memory, but
our brokers can't use that much
exactly
CPUs or memories yet. But
it was more than we needed. And it had like two NICs, right? And what was different here is that it actually had a locally attached NVMe storage. So NVMe is very powerful, as well as it's locally attached. So it doesn't have to go with the network, the way that this one does. So we kept it like this because with Oracle, the storage is it's available for free with bare metal. So we wanted to kind of show what you can get out of box with the bare metal performance, rather than try to do an apple to apple comparison and show what you can get with bare metal but with remotely attached storage. So with these two different setups, we used our different 200K tier broker. Our software broker can scale vertically, which is a great thing. So you can use the one that suits your requirements the most, optimize it for cost and so forth. So let's look at the numbers, right?
Our hardware appliances can also scale vertically, Himanshu. You just buy a bigger NAB or buy a bigger
That's true.
ADV. So
That's true.
It's more involved though. You have to do some hardware swaps, but
Exactly.
our software broker, you just add more CPUs and restart it, and there you go.
That's true. So the results, right? So there are a lot of details about what we did to get these results, but actually, we didn't have to do too much of tuning on the host. Actually, most of it was as we got it. We did try to do a lot of tuning, but it actually didn't make that much difference. So that was pretty cool that nowadays you don't have to be a specialist and like do crazy tuning to get these extreme results. They're kind of available out of box. So the throughput for direct messaging, right? This is in-memory messaging. It is not bound by the disk type, which is why you're seeing that both for standard VM and bare metal, we got the same results, which is nice that we can show that. The ingress was 1.75 million messages per second, and the egress was 8.7 million messages per second. And this is with 100 bytes payload, which is typical for your market data scenarios, which is what direct messaging mostly gets used for. So really cool that you can get 8.75 million messages per second in cloud on a VM with a software broker.
Did you try going to like a bigger fan out rate, just like a 1 to 10, just to see if you could push that egress number higher?
You could tweak so many different things. So we did have to kind of fixate some parameters so that we can compare. We chose fan out of 5 just for the heck of it, but you could do different ones. And the reason how we decide this is it, right? We could push a little higher, but you start seeing discards. So when I say that we were able to get 8.7 million messages per second, it is without losing a single message. Right. And we did run the same test 3 times consecutively successfully to say that, okay, this is it. Because sometimes you do get it right, like the first try, and the second rerun, something goes wrong, and it fails. So then we don't pick that number.
That's when you're right at the edge. So in SDK Perf, I guess you're using -OC, the order checking flag.
Mm-hmm.
Yeah. All right.
Yeah. For latency, so now for latency as well, you can do different types of configurations. Like the broker is on VM or on bare metal, but where should my clients be? Are they running on the VM as well? Are they running on bare metal? We decided to go with very vanilla configuration that if both the broker and the clients will run on VMs or they will run on bare metal. They're all very closely located, so they're in the same availability domain, or in AWS terminology would be availability zones, right? So you want to minimize the distance as much as possible. You could go a step further and actually use cluster placements, right? Did I get it right? I'm forgetting the exact, I think cluster. TK, remember what it was? Cluster placement clusters? Or cluster
that sounds right.
Placement groups.
Placement groups. Right.
Yep.
So to make sure that the the 2 hosts are on the same are as closely located as possible, right? So you would get even shorter distance and much lower latency. But we didn't do that in this case. So in this case, you can see that for the VMs, we're getting 394 99.9th percentile microseconds latency. So a lot of people, a lot of vendors would quote you the average or maybe even 99th, but in capital markets, you really want to see 99.9th percentile. So this is as stable as you would get. And you can see the standard deviation is pretty low, only 24 microseconds, right? When you go to bare metal, you see it drops more than like 50%. So 190 microsecond, and average is only 91 microseconds. So that's standard deviation machine in the cloud. Now, and a hardware broker is 18 microseconds, and the software broker on the cloud is giving you 190 microseconds. So again, if you're thinking of moving stuff to the cloud, your requirements are very different. So you're never going to try to say that, okay, I can get 18 microseconds for this use case, and I need to have that kind of latency on-prem. Let me try to achieve 18 microseconds in the cloud. Typically not how you would do it, at least not today. So these use cases that are moving to the cloud, they don't have the same latency requirements. But you can see here that we're getting very close, and it will only continue to get better. Which is, I always say that anyone who's making excuses now about moving to the cloud because of performance, those are not the right reasons. There are different reasons to decide whether or not you want to go to the cloud. performance is less and less becoming the reason, right? Guaranteed messaging, we did the throughput testing for that. You can see we tested payloads of 1 kilobytes and 1 megabytes, and egress you can achieve 1.2 million messages per second on the VM, and with bare metal you can get 1.55. This is mostly because of the local attached high throughput disk, the NVMe storage that we have there. And similarly, you can see that the egress for 1 megabyte is 2K messages per second versus 4.8K messages per second.
With 1 megabyte payload. Wow.
Yeah. And we can go up to 30 megabytes, right, for guaranteed messaging.
Guaranteed messaging, yeah. Even our smallest brokers, that's a recently released feature. It allows small brokers to be used in a DMR mesh with appliances and larger brokers, and to not, because for quite a while, our small brokers, the small software brokers, had a 10 megabyte limit. So.
Yeah. So my colleague Emerson did late last year did similar testing with Azure, and the setup was similar, not exactly the same, but similar. And they were testing different types of instances that Azure has. And Azure came out recently with very powerful instances and very high performant disks. So we were kind of testing different types of configurations. So you can see the 4 instances that were tested and with what kind of disk. And Aaron and I recently ran into this with a customer as well. The importance of the disk IOPS and throughput. And when you spin these up in the cloud, many times you'll get the very minimum configuration, because obviously there's cost implications. So when you spin up a premium SSD v2, your default IOPS might be like 125 IOPS, right? And that's not what you want for your high throughput use cases.
Ooh, 125, like
something like that. Yeah, it was like very low, right? So you want to tune these things. Or maybe I was referring to the throughput. So you want to tune these things properly, because 1, they have cost implications, 2, they'll have performance implications. So you want to match these to what your use case requires. And once you have these kind of settings configured properly, you can see the kind of performance we got on Azure on different types of instances and with different disks. So I'll leave you to look at these blog posts, and we will soon be releasing one for AWS. To show what we did over there and what kind of numbers we're getting there. So
if you head over to solace.com/blog or blogs, you should be able to search for these things, kind of probably looking for performance. Pretty easy.
Yeah, and just a sneak peek on our outpost testing. So Manuel Moreno, who's
for
part
AWS,
of my team,
right?
Yeah, who's part of my team, is running with the test. And so we're testing with Outpost Bare Metal, which essentially is an on-prem server infrastructure that AWS provides you, that's extremely tuned and has Solarflare cards and very modern, up-to-date switches, and then you control it essentially from the cloud. But essentially, we've started testing there, and then we were able to achieve 70 microseconds of average latency, which beats the OCI benchmarks, and that's just without any tuning, without any sort of making any efficient use of the various flags, like turning off Nagel's algorithm. So out of the box, we're able to get 70 microseconds, and confident that we're going to be able to do much better. So look for that in the coming weeks. But Solace Broker we continue to make investments in Solace, not only in our hardware appliance, but in our software broker, to get it to perform faster and better, and get it and have it unlock some of the use cases for our customers in the cloud. And so as we release almost every single release of the Solace software broker going forward, we'll show some performance improvements in a variety of areas.
That's right.
And what's really good is that the especially if we talk about financial services and large banks that have been using us, right, for these performance sensitive use cases, they also have other use cases and other lines of businesses that don't require the same level of performance. So they don't need to rely on a hardware. They can use software broker, and they also have different needs. So direct messaging for market data distribution versus guaranteed messaging for higher value messages, or
pretty much everything else, actually. I mean,
exactly, like back-end use cases that TK was talking about price distribution to the trader UI that needs to then stream those data. So other brokers can't accommodate all of these variety of use cases. Only Solace can, as far as I know. For example, support for WebSockets is like
Native.
we are
Yeah.
a lot of our banks customers use us for that, because we can actually take data from your wherever your messages might be. It's great if they're already on Solus, but many times they're just sitting on your Kafka, and Kafka doesn't do WebSockets. So then you need to use Solus brokers to then push them to someone's UI's notification layer. And if you use Solus for your high performance stuff and like all these others, that gives you a very consistent, uniform messaging layer with one API to rule them all, which I think simplifies your architecture a lot.
Well, we have multiple APIs for Solace, so I mean, you don't necessarily have to consume us with our standard native format either. You can use MQTT, third-party data distribution. You know, if you're running in the cloud and you want to provide a socket with your market data feed, you don't even need to use a Solace API.
Like REST as well. We have
REST.
a major hedge fund that uses Gravity, because they have external portfolio managers that need to issue trades, and they use basically REST post through Gravity that then sends messages to Solus, right? So just having REST capabilities, because not everyone is high tech and using event-driven APIs and all that stuff. Yeah. So a lot of the products that you need to integrate with, especially on cloud, you rely on REST, and we can do that natively.
Yeah. Quick comment here from our friend Running Roach. It would be good to see a curve based on message size, successfully tested, et cetera, et cetera. You know, that's interesting, because we do have, we do have data. Let me actually show something really quick. Something like this, maybe. Is that the kind of curve? Maybe looking at fan out versus message size. So Solace, the QA team, do run sweeps, generating for a range of fan outs, for a range of message sizes, and a range of publisher. It's a lot of data to run, and I think Himanshu, you probably picked certain numbers because you didn't want to like spend a week running these tests just to do all sorts of.
It's a lot of data to run and cost.
It's a lot of data to run, right?
Even our QA team, I think I forgot the number, but they gave me a cost for each of that cell that you're showing, and there's a lot more of those.
Sure.
How much each cell costs?
So if Running Roach, if there are certain fan out / message sizes / performance things that you want to know about, we might have data for that available in our internal performance documentation. But yeah, I basically took one of those tables and I threw it into our chat AI. This is our Solace chat bot that we use that runs on the Solace Agent Mesh, one of our more recent products, which is what's good. Next month's office hours is going to be all about Solace Agent Mesh. And I told it to make some graphs, and it pulled in some graphing, and I was like, can you make this a log scale? And then the colors got screwed up, and yeah, it's I was just chatting with my chatbot making these cool graphs. So I thought that was kind of neat.
It's actually with the cloud, it's not so hard to test, right? Because you can automate a lot of that. So instead of us trying to measure every single use case and spending a lot of cost and time and resources on putting a bunch of stats that many people won't even be able to relate to, it's much easier for, like, if someone asks, like, I can just run those tests very quickly, show you, like, for that specific configuration, what kind of throughput you would get, which is what I do for a lot of my POCs. I'll test them myself first to get realistically what can you get on EKS versus OpenShift and all that.
Cool. A quick question from Kieran before he leaves. Wondering if the slides are available to share after the session. Well, this will be stored. This is on YouTube. Kieran, if you head over to YouTube and look for solace.com, our channel is called solace.com. Under the office hours, this entire thing is there. But TK, your little slideshow presentation, is that available publicly, or should Kieran just watch the replay?
Just watch the YouTube. I would say it's not wishing it available publicly.
That's right. We have Anne joining from the beginning of the stream, I guess. I hope maybe she'll watch the whole thing. But hello from UK. That's great. One last question before we wrap up. I know Himanshu has a customer call that has to duck out for. I have it for an appliance and one done for old VMRs, VMR software broker. This new stuff I really do want to have on hand to be able to present facts to people that need hands, hearts, and minds convincing. Yeah, so we can happily provide some of the performance data that we have for different versions of the software broker and for the appliance. Just reach out to your friendly Solace representative. So great. Gentlemen, I think we're right at the top of the hour, so I think we should wrap it up. And like I said, yeah, Himanshu has to jump on another call, so thank you for taking the time to do this. Any last words before we roll the credits here?
No, just if you need any help, or if you want to talk more about Solace in any industry, not just has to be financial service, just reach out to any of us. We'll be happy to talk more about
Solace
performance.
community, you can find us there. That's probably a great way to find us, or on LinkedIn.
Yeah.
TK?
All right. Yeah. Thanks. We're all good. And had fun. And hopefully the audience has learned a little bit about Solace usage in capital markets.
I learned a few things.
Yeah,
So
but fixed income,
Always
yes.
good.
thanks for coming, guys. See you next
All right,
time.
thank you.
All right. Bye, everybody.
Bye. Take care.
All right.